To the markets and your investment portfolio. The S&P 500 hitting another intraday record high today after a couple data points signal that the economy is still on solid footing. But our next guest thinks that investors might want to prepare for a little bit of volatility ahead. To discuss, we've got Thomas Hayes, who is the Great Hill Capital LLC chairman and managing member here. Great to have you here in studio with us, Tom.
Great to be with you.
So let's discuss this. I mean, what type of volatility profile should people still be kind of keeping their portfolios ready for to weather as well?
Yeah, Brad, I think we had a regime change got locked in last week with the front-loaded 50 basis point cut. And what that implies is that the heaviest weights of the S&P 500, the Magnificent Seven, I think they're going to be a little bit choppy moving here. I think moving forward, history suggests that the unmagnificent 493 will outperform the Magnificent 7. That's because their earnings growth is accelerating while the Magnificent 7 is decelerating. History also suggests after the first rate cut, small caps will outperform large caps by over 11% in the first 12 months. So that's a big deal. Value outperforms growth in the first 6 months after the first cut. And as you probably noticed, everyone has been crowding into defensives ahead of the Fed cut. So I think you're going to see consumer discretionary start to outperform staples. Everyone's crowded into staples and utilities. I think that trade is up. And finally, this is the topic du jour today. Okay. Emerging markets will start to outperform developed markets after 10 years of not happening. The Chinese government overnight launched the bazooka. Everyone said, oh, the monetary cuts are pretty good, but we need fiscal. Well, they're issuing $286 billion of bonds. They're giving out money. Things are happening, and the green light is on. That's going to help not only emerging markets, it's going to help multinationals like Nike, that's been down, Lululemon, that's been down, Starbucks, that's been down on China fears. Yeah,
a huge stimulus effort that they're putting forward here and having more international impact here. You know, it's been interesting to get some perspectives on what quality looks like, what the characteristics of quality investment and people who are trying to put quality into their portfolio, what that looks like. What are some of those characteristics from your perspective as well, even as you think about the defensive plays that people can make or how you can make sure that your portfolio is able to weather any type of volatility right now?
Yeah, so you started with the kind of concerns about a little bit of choppiness into October. What made me a little bit on alert is the fact that skew, which is the cost or the implied volatility, the cost to insure 1 to 2 standard deviation corrections, think about 10% plus corrections, has actually skyrocketed to a decade high. That doesn't guarantee that you're going to have a correction right away. It just says it's time to be on alert because the smart money is taking out a lot of insurance. That differs from the VIX, which measures the cost of the at-the-money premium or insurance. So I think if you're on margin, you want to be off margin. We're fully invested. We're going to stay fully invested, ride out any bumps in October after the election clears, provided it's a gridlock outcome, regardless of who becomes president. I think we get a year-end rally, so you don't want to be stopping and starting. I just think it's time to be a little alert, particularly if you're a passive investor and you're overweight the Magnificent Seven, even if you don't know it.
For, it seems like months now, investors have had to hear about the broadening. When the Magnificent Seven and the successes seen in the Magnificent Seven, it would broaden out to other earnings growth or earnings growth of the other 493 companies as well. Are we starting to see that? And if so, is it sustainable as we get into the back half of this year and earnings growth, regardless of the macroeconomic backdrop, comes into focus?
We are seeing it because you're seeing the equal weight index outperform the cap weighted of late. Okay. And this was an inflection quarter where the unmagnificent 493, as you referenced, broadening, just inflected and started to accelerate earnings growth. They had negative earnings growth in the second quarter. Yeah. So not only is it beginning, it's going to accelerate. Small cap earnings growth, 7% this year, 37% next year. So the game is on. It's exciting. It's a stock picker's market. And I'll tell you, the voodoo of China, there's some high quality companies. And to your point, how do you define quality? Is price is what you pay, value what you get. So we want to see a meaningful return on invested capital. That means the debt and equity that the company's taken in. What kind of return are they getting when they invest? We like double digits, low double digits, mid double digits. So there are companies over there. And we like to buy things that are out of favor. As you know, we've talked for many years. So in the US, our best tech companies are trading at 23, 25 times. In China, their best companies are trading at 8 or 10 times, and they've got a ton of cash on their balance sheet. And with this stimulus, their economy is going to reaccelerate, and there's going to be huge opportunities, not just for US multinationals that are trading down because of China, but for actually some of the highest quality companies in China that have been left for dead.
It's really interesting. Tom, always a pleasure to grab some of your insights. Thanks so much for joining us in the studio here.
Thanks for having me, Brad.
Absolutely. Tom Hayes, Great Hill Capital, Chairman and Managing Member.